I'm going to walk you through the 5 strategies that high income earners can use in 2025 to cut their taxes by 25 to 98%. Now, the reason I say 25, I know that's on the low end of what you've probably seen me talk about in videos. And if you're new here, that's on the low end. I typically say I can cut your taxes in half, which is true. The reason I said 25% in this specific video and for this specific document is simply because one strategy on here, all it does is either generate a 25% refund on your taxes or discount. It is guaranteed and it is backed by a very large financial institution, or hedge fund, I should say. But that's the reason why you see 25%. Most of these strategies, understand, will cut your taxes in half. So the first thing I want to talk about is mainstream advice for tax mitigation. It's not bad advice necessarily. It's really just the basics. 401k maxing, taking the SALT deduction, the mortgage interest deduction. See, all of these things are good and they're tried and true, but as my dad would say, it's like throwing a lawn chair off a cruise ship. It's just not going to make that much of a difference. Taxes are not just a burden, they're an expense. For you watching this video, if you are a high income earner, $250,000, $500,000, $1 million a year in income, they're likely going to be your biggest expense, typically costing you hundreds of thousands, if not millions of dollars over your lifetime. And that's because people just rely solely on standard deductions and basic write-offs. So the tax code, it is formally called the Internal Revenue Code, IRC. It's codified as Title 26 of the United States Code. This is the primary body of federal statutory tax law in the United States, enacted and maintained by Congress. Now, more often than not, in this document, I'm going to refer to this as the code, okay? I don't want to get too confusing on IRC, United States Code, anything like that. Now, there's a time and a place to use that language, but for you, I just want you to understand exactly kind of the high-level possibilities of what these strategies could do for your situation, specifically in regards to your tax situation. Now, the actual code, it's made up of 2,600 pages. When you include everything else, the revenue rulings, the procedures, the private letter rulings, tax court cases, opinions, etc., it balloons to 70,000 pages. Here's the big picture of what you need to know. 30 to 40 pages, that is going to explain exactly how much you owe. The rest of it is an owner's manual that explains how to reduce your liability legally, your tax liability legally. Now, this in and of itself is the main reason why the overwhelming majority of CPAs, they don't show high income earners how to legally reduce their taxes. They focus on those first 30 to 40 pages and they don't have the time, energy, or incentive to research the remaining 69,960 pages and then bring that guidance to their clients. So the best way I could kind of help you think about most CPAs, and I'm not taking a dig at your CPA. I just have met with so many high income individuals who say, my CPA says this is just what I owe. Well, your CPA more often than not is like a general practitioner. They're essential for the routine checkups, the annual filings, making sure everything looks normal on the surface. But just like a general doctor might miss a complex issue that requires deeper analysis, most CPAs focus on reporting, in what already happened, rather than proactively diagnosing future risks or opportunities. So a mentor of mine told me that there's postmortem CPAs, those that focus on what's happened, and then there's forward-thinking CPAs. And personally, I can work with both of them because I'm not a CPA. I'm not trying to file your taxes. I just want to help you keep more of your hard-earned money. So in this guide, I'm going to share 5 strategies that the rich and powerful are using right now to reduce their taxes. You've heard of high income earners paying less in taxes than their secretary, but how? That is always the question. Well, they either A, have someone like me on staff, or B, in their network. So my goal is to share these strategies with you and then help you execute on them to realize a net savings. I don't want to replace your CPA or file your taxes. No thanks, that is not my job. I simply want to help you keep more of what you make. Strategy number 1, Medical LLC. All right, this is a strategic charitable giving program that's facilitated by top tax attorneys, and it's facilitated through a structure based in Salt Lake City, Utah. It's designed for high-income earners who want to support first responders and underserved communities while getting some of the most powerful tax deductions available under the law. So you contribute cash. The cash secures rights to a manufacturer breakthrough, health product using C60 nanocarbon technology. I know that's a lot. An antioxidant being distributed to the frontline heroes through vetted 501c3 charities. So in return, you receive a charitable deduction of up to 60% of AGI, a 7.5% ordinary loss deduction, IRS compliant documentation, K1 third-party appraisal acknowledgement letter, and a 5-year carry forward on unused deductions. Now, as with most tax strategies, actually pretty much all tax strategies, if we're being honest here, it requires a cash outlay. You spend money to save money. If you spend enough to realize the net savings, good. You now have more money than you did in the first place if you would have just paid full taxes and not executed on strategy. If not, and you don't come out in the green, you would not use this strategy. Okay, so here's how it works, step by step. Step 1, you contribute cash to a special purpose LLC. Step 2, the LLC receives the manufacturing rights to the C60 supplement. Step 3, those rights are converted into gift cards. Step 4, you choose what you do with them. You can donate them to a pre-approved charity, which is recommended. You could redeem them for cash, or you could keep the product. When you donate, you receive a fair market value tax deduction. You receive all the supporting documents so your CPA can validate the write-off. As simple as that. And again, this strategy, in a lot of my videos, you'll see me talk about it. This allows you to write off up to 60% of your adjusted gross income. Great for W-2. This is a great strategy for W-2 because most strategies that I'm going to talk about are for business owners. But this strategy, you could be W-2, and you always hear CPA say, W-2, there's not much you could do. That is this strategy right here. You'll realize some great net savings if you're paying more than $50,000 a year in annual taxes. Okay, strategy number 2, the tax bond. This is another great strategy for W-2, but this works for business owners, W-2 employees. This is going to work for any corporation that's paying taxes. This is a tax loss monetization strategy structured through a grantor trust using the CARES Act era tax assets. So it's built for high-income earners, individuals, business owners who paid $150,000 or more in federal plus state taxes combined in any single year. It has to be 1 year, and then we have to still be in the amendment window. So here's the short version. You invest in a tax bond at 75 cents on the dollar, which gives you a legal interest in a grantor trust that holds real deduction generating assets, primarily net operating losses, NOLs. And I have a full video on this, so I'm not going to go too in depth on this. If you want to watch that, it's on my channel. But again, it's using net operating losses, and then you amend your prior tax return, or you can use it for 25 or 24 if you haven't paid 24 yet. I'm making this video on June 27th, 2025. So if you still haven't paid 24, you could use this strategy again. And it's just going to give you a 25% refund. It's as simple as that. Take your tax liability, multiply that by 75%, and that's going to be the difference is going to be your savings. So you purchase a bond at 75 cents on the dollar, a tax bond. The bond converts into ownership interest in a grantor trust. That trust holds the CARES assets, primarily 2020 losses eligible for the 5-year carryback. You receive documentation assigning your beneficial interest and deduction amount, and then your CPA files an amended return, and refunds are typically received in 2 to 12 months. It's kind of hard to gauge it because it's out of our control, it's the IRS, but that's about the average time. Now the example I'm going to have for you here is taxes paid in 2022, $200,000. You purchase a bond for $150,000. You receive a refund for $200,000, and you pocket the difference, which would be $50,000. And this deduction, I'm not going to go through all this, but the deduction is based on economic activity substantiated by legal and tax counsel, and then you could read that right there. The audit protection is automatic, and it is contractually built in. There's no exposure to future income, no deferred tax consequences. Everything is reported properly and transparently. This strategy is not for everyone, but if you qualify, it's one of the only few ways to legally recapture past taxes you've already paid. 25% refund, we can go back 3 years at this point. That's 75% rate of return. That's not a bad return on investment. And it works for W2 again. So strategy 3, this is only going to be for business owners. If you're W2, this is not going to work for you. This is going to be for business owners only. This is a 179 based tax strategy that allows you to deduct 100% of a business technology purchase up to 1.25 million, unless the one big beautiful bill passes. If that passes, this number could double to 2.5. As of right now, it is 1.25 million. And you could write that off in the year it's placed in service. So it's designed for business owners who are paying $50,000 or more in taxes, and they want to redirect that money into something that actually grows their business while creating a significant write-off. So you buy an AI integrated technology package that qualifies as tangible personal property under the IRS rules. It includes hardware plus software, making it fully deductible under 179. You finance 80% of the purchase and you put 20% down, unlike a typical loan. You don't make monthly payments with cash. You can, but you typically are going to use loyalty points by staying active in the program. Those points are used to pay down the remaining balance, including both principal and interest. So here's how it works. Step 1, use a unique agent link to access the technology package website. And if you're going to do something like this, you would work with someone like me or someone that actually brokers this product. You wouldn't do this on your own. In fact, there's no way that you could do this on your own, because every agent that brokers this product, they have a unique link. They have the training that explains exactly how to give you the most bang for your buck. You just wouldn't do this on your own. Anyways, I digress. So after you get the link, use the automated enrollment process on the website to purchase the package. It takes about 15 to 20 minutes. Then you get a purchase and finance agreement for the tech package. It's electronically signed and wire instructions are provided. You wire the down payment, automatically receive a purchase receipt showing the down payment and financed amount. And then your CPA is going to use that purchase agreement and payment receipt to document the transaction for deduction purposes. So if you purchased, let's say, a $500,000 technology package, you would put $100,000 down. You would finance $400,000, and then you would deduct all $500,000. And so let's say you're going to pay $125,000 in taxes off your $500,000 of profit. Well, what you could do instead is invest in your business to max out your 179 deductions, spend $100 to write off $500, and then you pocket that $25,000 difference. Now, those are not exact numbers. That's just generic numbers that I'm throwing out off the top of my head. Again, this strategy is designed not to compete with, the truck that you needed that you're writing off, but to maximize 179, invest in your business, allow your business to be streamlined, but ultimately realize a tax savings, come out ahead on a tax perspective. If you're not going to realize a tax savings, well, there's potentially better options in terms of technology packages out there that you can use. But if you're going to realize a tax savings, why would you not write off the technology package? So anyway, I digress. The whole point, though, again, is to put money back in your pocket. Now, strategy 4, tiny homes. This is another 179 based tax strategy that allows you to deduct 100% of an income producing tiny home, again, up to 1.25 million, in the year it's placed in service. So this is for high income individuals or business owners who want to reduce taxable income while acquiring a hard asset that produces passive income, a whopping $41 a month, I believe. Most people are doing this for the tax benefits, though. Okay, so you purchase a steel framed, fully equipped tiny home, and that qualifies as personal property, not real estate, under IRS rules. We have legal opinions on all of these, but on this specifically as well that I can show you. That classification allows for a 100% Section 179 deduction. You finance 80%, you put 20% down. The home is already leased to a workforce housing operator in West Texas in the oil fields. So you don't make monthly payments with your own cash. Lease income from the tenant covers all the operational costs and note payments until the unit is paid off. Okay, so here's how it works. Number one, you sign a purchase agreement, financing agreement for the tiny home priced at $350,000. You wire $70,000 for the down payment. The remaining $280,000 is financed over 30 years. A lease is already in place and the property management company collects rent and handles all the expenses. They handle everything, right? And then you receive a purchase receipt showing the full purchase price and down payment, which your CPA uses to document the deduction. The tiny home is placed in service as an income producing property during the 2024 tax year or 2025. This just says 2024 here. Whatever year you purchase the tiny home ultimately, triggering your right to claim the deduction. So again, I know this is 2024 right here, but it's going to be dependent on whatever year we're currently in. I just need to update this document. So I do apologize for the error on the 2024. It should say 2025 for this year. Want to be very clear on that. Now, example here, purchase price, $350,000. You put 70 down, again, with $70,000 that was already going to the IRS. Instead, you would purchase one of these tiny homes, finance $280,000, cash flow a whopping $41 a month, and then you could write off all $350,000 this year. Now, this will work for W-2, but there's going to be a lot of extra hoops essentially we have to jump through. It's mainly for business owners. If you're W-2, again, we'd probably look at the medical LLC before we look at this, but just know it's a possibility. So I think I contradicted myself because at the beginning of the video, I think I said medical LLC was the only option. There's a couple more options for W-2. This strategy will also work for W-2. Very, very advanced strategy, and that's why I put it last. Okay, so this is a tax advantage company. This is an entity structure that allows high-income business owners to create their own tax advantage company, donate 98% of the ownership to a 501c3 or donor advised fund, claim a substantial charitable deduction up to 198 of the contributed value. It's designed to do good for society by donating to charity, and as a result, reduce income taxes, eliminate 98% of capital gains taxes, and create a vehicle for long-term tax advantage growth and legacy planning while still retaining full managerial control. So here's a short version. You form a new company, a TAC. You donate 98% of the non-managing member shares. Key, that is a key, okay? I'm going to say that again because I really want you to understand this. You donate 98% of the non-managing member shares to a qualified charity and retain 2% as manager, but retain 100% of the control, okay? So you donate 98%, you own 2%, but you have 100% control of the LLC. Very, very critical to understand that. And this was something we'll go way more in depth on if you're selling a property or anything like that, or you're selling a business, I should say. But it works with highly appreciated, depreciated assets. Okay. You then contribute assets into the TAC. This contribution is tax deductible, and the TAC can invest in assets or issue loans to generate returns that flow back into the entity. A lot of very cool things you can do. Just understand if you're going to sell a business or piece of real estate where you're very, very high income, $500,000 plus, this is a very good structure for you to not only do good by others by donating to charity, but also reducing your taxes while still remaining in control of your money, 100% control of your money. So, step one, we're going to form a TAC, LLC, with the help of a qualified tax advisor. I'm not going to say this about any other strategy, but do not even consider using this strategy if you are not working with a qualified advisor, a qualified tax advisor. I do not set up the actual LLC for this, okay? I have tax attorneys that I work with that actually do that, okay? So do not try to do this one on your own. Some of these you could get away with doing on your own, like tiny homes. You could probably get away with doing that on your own. You would still need to find someone to ultimately help you purchase the product, purchase the actual tiny home. But this one, no, do not try to do this on your own. Step two, you donate 98% of the ownership interest, non-managing shares, to a 501c3 donor or donor advised fund. Step three, retain 2% ownership, but 100% control. Step four, contribute assets, cash, stocks, real estate, etc., to the TAC. These can be invested or loaned out. Step five, you're going to receive a charitable deduction of up to 98% of the contributed value usable in the current year or 5 years carry forward. Step 6, you're going to use the TAC to make investments or loans aligned with your financial goals and charitable intent. Step 7, pay tax on 2% of any gains moving forward. So you're going to have, let's say you're going to sell your business for $10 million. You're going to face $10 million in capital gains and would typically owe taxes on the full amount. So depending on where you're at, maybe $2, $3, $4 million possibly, depending on the structure that you're currently in. If you use the TAC, you will pay taxes on $200,000 total. 2%, because remember, you're paying taxes on 2% of the sale of your business. So you're paying taxes not on 10 million, but on 200,000, which would be about 30 to 60,000, maybe a little bit less, maybe a little bit more. Those are, this is napkin math, right? It's just to illustrate a point, depending on your state. So, and then as I say, obviously, this is an oversimplification of the entire process. Again, don't attempt to do this on your own. You're going to want, attorney, advisor, accountant, etc., who all have experience in this structure, which my firm, we do have experience in this structure. But there's a lot of people, I shouldn't say a lot of people, but there's a handful of people in the country that are using these. And we're seeing the TAC to be more and more popular with the wealthy and then mass affluent, $500,000 of income and up. So now, if you want to see a net savings and what your net savings would look like, I guess my video is going to cut off here. If you want to see a net savings, I offer private one-on-one consultations to help high-income earners like yourself identify which of these strategies make sense for you and your specific situation. I follow a 3-step process, very, very simple 3-step process. Review, reveal, resolve. Now, I first start out with reviewing your situation, how much you earn, what you pay in taxes, etc. If you pay more than $50,000, I offer a financial report and I guarantee you a net savings of $10,000 bare minimum, with most clients saving $25,000 or more. Then I'm going to reveal what strategies are actually going to work best for you. And then finally, we're going to resolve the tax problem by executing on the strategies. So I know you couldn't see that because the screen's not letting me scroll up anymore in my document here. But if you go to the link below, you can download this entire guide, go through it by yourself. You and your CPA can go through it together. Now, I will say this, CPAs, I love working with CPAs. So if you want me to talk to your CPA, that's great. But a lot of them are not familiar with these strategies, so they need to be educated on these strategies. Which, if your CPA is okay and open to learning new things, that's great, I'm happy. But if they want to be the one that brings every strategy to the table and they don't work with anyone outside because, they just have been doing this for 40 years and, a guy like me can't teach them anything, hey, that's fine as well. But my goal, again, is if you're still paying $50,000, $100,000, $200,000 or more a year in taxes, I can cut your taxes in half like that within about 30 minutes and help you realize a net savings. So thanks for your time. Hope you found something useful in this video, and I will see you on the next one. If you're watching this today on Friday, have a great weekend. If not, take care. Talk to you soon. Bye.